You've seen the simple formula, right? To make $50,000 a year from dividends, you just divide that by your portfolio's yield. At a 4% yield, that's a neat $1.25 million. Easy enough. But I'm going to tell you something most people won't. That simple calculation is a trap. It's the very reason many aspiring dividend investors are going to fail. That number, the one you see in headlines and basic calculators, is dangerously misleading. It ignores the invisible forces that are quietly working to destroy your income and slam the brakes on your financial freedom. In this video, we're not doing that simple math. We're doing the advanced calculation, the one that actually prepares you for the real world by factoring in the three hidden portfolio killers: inflation, taxes, and risk, so you can find the amount of money you really need to live off dividends forever. The simple math and the dangerous trap. First, let's quickly break down the math that gets everyone so excited. You have to understand where most people start to see where they go wrong. The formula is super straightforward. Your desired annual income divided by your portfolio's dividend yield equals the lump sum you need. Let's use a common goal: $60,000 a year in passive income. If your portfolio has a dividend yield of 3%, you need $2 million. If you get that yield up to 4%, you need $1.5 million. And if you really push for a 5% yield, you only need $1.2 million. This is where most articles and videos on the topic just stop. They show you this table, tell you to pick your yield, and wish you luck. And that is the trap. Why? Because this number assumes the world just stands still. It pretends that the $60,000 you need today is the same $60,000 you'll need in 10 or 20 years. It pretends the tax man won't come knocking. And it pretends a 5% yield is just as safe as a 3% yield. None of that is true. Relying on this simple math is like planning a cross-country road trip, but forgetting to budget for gas, food, or a flat tire. You're going to end up stranded. So, let's start budgeting for the real world. The first hidden killer. Inflation, the silent thief. The first and most relentless killer of your dividend income is inflation. It's the silent thief that makes your money worth less every single year. A fixed income stream that doesn't grow is actually an income stream that's shrinking. Let's go back to our $60,000 a year goal. Today that might be great, but what about in 10 years? Assuming a steady average inflation rate of 3% in a decade, you would need over $80,000 to have the same buying power. After 20 years, you'd need over $108,000. Of course, inflation isn't always a constant 3%, but it's a realistic, long-term average to plan around. Your static $60,000 dividend income will feel like you're taking a pay cut year after year. That's a terrifying thought when you're supposed to be in retirement. So, what's the solution? The antidote to inflation isn't just yield, it's dividend growth. You need to build a portfolio of companies that don't just pay a dividend, but have a long history of increasing that dividend year after year. Historically, S&P 500 dividend growth has outpaced inflation over the long run, and that's the trend you want on your side. These are your dividend aristocrats or dividend champions companies that have consistently raised their dividends for 25 or even 50 consecutive years. They get it. They know their investors need an income that grows. A portfolio that yields 3% but grows its dividend by 6% annually is infinitely more powerful and sustainable than one that yields 5% with zero growth. The first one protects your future. The second guarantees your future gets more expensive. Your plan must have an income stream that outpaces the rising cost of living. The second hidden killer, the inescapable tax bill. Now for the part that gets even more complicated. You figured out your inflation-adjusted income goal. But guess what? You don't get to keep all of it. Before a single dividend dollar makes it to your bank account, you have to pay taxes. And not all dividends are taxed the same way. In the US, there are two main types: qualified and non-qualified dividends. Qualified dividends are what you typically get from holding common stocks of US companies for a certain period. They get special treatment and are taxed at long-term capital gains rates, which for 2026 are 0%, 15%, or 20%, depending on your income. If you're married and your total taxable income is under about $99,000 in 2026, you could pay 0% in federal tax on those dividends. But ordinary dividends are a different beast. These often come from investments like real estate investment trusts, REITs, or from stocks you've held for only a short time. These are taxed at your regular income tax rate, which can be much, much higher. We're talking 22%, 24%, or even up to 37% for top earners under current law. Let's see what this does to our numbers. Imagine you need $60,000 in after-tax income. If your portfolio is full of qualified dividends and you're in the 15% bracket, you'd actually need to generate about $70,000 $600 in gross dividends to end up with $60,000. But what if a big chunk of your portfolio is in high-yield REITs paying ordinary dividends and you fall into the 24% tax bracket? You'd need to generate nearly $79,000 to get that same $60,000. That's a massive difference. Now, it's worth noting that many REIT dividends are eligible for a 20% qualified business income deduction, which can lower that tax bill. But the point remains, the type of dividend matters. On top of all this, you might have state taxes or a 3.8% net investment income tax for higher earners. Your real number has to be a pre-tax number. You have to work backward from what you need to live on, then figure out how much more you need to earn to pay the tax man. The simple formula completely ignores this. The third hidden killer, the high-yield risk trap. At this point, you're probably thinking, okay, I get it. I need more income for inflation and taxes. I'll just hunt down stocks with the highest possible yield to get there faster. Whoa, slow down. This is the most dangerous trap of all. A super high dividend yield is often a warning sign, not a golden ticket. The yield is just the annual dividend divided by the stock price. So, what happens if a company is in trouble and its stock price tanks? The yield shoots way up, making it look incredibly attractive. But it's a false alarm. History shows that companies with shaky finances, too much debt, or ridiculously high payout ratios are the ones that often sport those sky-high yields. Research has indicated that companies with the highest yields are also more likely to cut their dividends when trouble hits, which instantly vaporizes your income stream and often crushes the stock price at the same time. True financial freedom from dividends is about reliability and sustainability, not chasing the biggest number. A portfolio of quality, blue-chip companies with yields in the 2.5% to 4% range, paired with strong dividend growth, is almost always safer and more effective for the long haul than a basket of risky high-yielders. Diversification is your friend here. Holding somewhere between 20 and 60 different quality stocks is a widely accepted guideline to protect yourself from a single company blowing up. Remember, the goal isn't to generate income for just 1 year. It's to generate a reliable, growing income stream for the rest of your life. Chasing yield is a short-term gamble, not a long-term plan. Finding your real number, the advanced calculation. So, how do we put all this together to find your real number? The bad news is, there's no simple, one-size-fits-all formula anymore. The good news? We have a framework to think about it the right way. Let's build a realistic scenario. Step 1. Define your after-tax income need. Forget the gross number for a second. How much do you actually need in your bank account each year to live your life? Let's stick with $60,000. Step 2. Estimate your gross income need, the tax-adjusted number. Now, let's account for taxes. Let's assume you build a smart portfolio of mostly qualified dividend payers, and your effective tax rate is around 15%. Your real income target is $60,000 divided by 1 minus 0.15, which comes out to about $70,600. This is what your portfolio actually needs to spit out. Step 3. Apply a safe and sustainable dividend yield. Forget those risky 7% yields. Let's assume you build a diversified portfolio of quality companies with a sustainable and growing yield of 3.5%. This is a realistic target for a well-constructed dividend growth portfolio, though it's an illustrative assumption, not a guarantee. Step 4. Calculate your real capital target. Now we do the final math. $70,600 divided by 0.035 equals $2,017,000. Let's just pause and look at that. The simple math might have told you that you could get by with $1.2 million. The advanced, realistic math shows you a number closer to $2 million. That's an enormous difference, and it's the difference between a plan that actually works and a plan that's doomed to fail. And remember, that 3.5% yield is just the starting line. The most important part of this whole strategy is making sure your portfolio's dividend growth rate stays ahead of long-term inflation. Look, if this is all starting to click and you're seeing this whole dividend thing in a new light, do me a favor and hit that like button. It really does help the channel out. So what's the ultimate takeaway here? Living off dividends isn't about hitting some magical number. It's about building a resilient, growing income machine. The simple formula is a myth because it ignores the real-world punches from inflation, taxes, and risk. Your real number is deeply personal. It depends on your spending, your specific tax situation, and the sustainable yield you can build with a portfolio focused on quality and dividend growth. Yes, that final number might seem huge. For a lot of people, generating $50,000 a year from dividends could require a portfolio somewhere in the $1.4 to $2 million range. But the path to getting there isn't a secret. It's about consistent investing, focusing on great companies, and choosing dividend growth over those seductive but dangerous high yields. It's about playing the long game. The math is a little more complex than most people let on, but now you have the right framework to build a plan that can actually last a lifetime. Thanks for watching. If you want to learn more about building a dividend portfolio from the ground up, subscribe for more videos just like this one. We also send out great, professionally made newsletters on financial freedom each week. So if you want that, be sure to sign up for our free newsletter using the link in the description. Now, go find your real number.